Excise. Excise is actually the other taxes that I know a lot of us didn't understand until Trump imposed tariffs, and then a whole lot of people have started wanting to understand what are tariffs. Those are customs related duties. It's actually excise also is on alcohol, it's on tobacco, it's on fuel. I'm just giving you, by the way, you pay tax on fuel, even though you can see there on your receipt, it normally says your VAT is zero rated, but you pay tax. I am employed by an oil company, so I manage indirect taxes on fuel. There's what we call duty at source. It actually has three components. It has your excise duty, it has fuel levy, it has your road accident fund. When they couldn't increase VAT with another 5%, what was the percentage? It was 5% that they wanted to increase it by. They actually couldn't increase it. They ended up increasing fuel levy with 15 cents petrol and 16 cents diesel, because we are not going to see that anywhere. Therefore, we're not going to ask questions. Are we getting this? So you were going to see that. That's why you procrastinate. You complained and you fought and you did all these things. But now this one you're not going to be able to see, because I didn't know about this tax until I had to deal with it. By the way, I worked for SARS, so with Lebu here. So some of the stuff I get because of I come from SARS. Then the other, so excise is 10%, then the other taxes is 7%. But what I'm trying to get you to understand, you're paying way over 70% taxes. Now, this is imperative then. This is one of the things that which are an enemy to the growth of those who are relying on salaries. That's the first. Secondly, your inflation is working against you. By the way, right now, we have what we call a tax bracket creep. Tax bracket creep is when the Minister of Finance does not take into consideration the inflation rate on the tax brackets for individuals on a year-to-year basis, right? What does that mean? Because before, what the Minister of Finance used to do was to take into consideration the inflation rate into the tax brackets, so that when your employer increases your salary band on an annual basis because of it's taking into account the inflation, it does not have to expose you to more taxes. Do you get my point? Because it's not a real increase. It's just taking into account inflation, right? Now, the Minister of Finance does not increase the tax brackets. That means by you getting an increase for the inflation rate, you can end up on the next tax bracket, meaning you're getting to get taxed more because of an inflation rate effect. Do you understand? These are enemies then to the increase. So recently I was listening to the news and they were saying about 40% of South Africans who are employees most employees in South Africa spend almost 40% of their salaries on utilities only. Guys, this is power, this is water, this is simple thing. There's no food item on all of those things. Now we go into why are we talking property then? Man, like how's property affecting all of this? Now, as an employee, so I normally speak to employees separately from corporates because of but we will try and actually mix it up. Yeah. All right, in the next few minutes left. So as an employee, you are getting taxed more because of you have less tax deductions, all right? Now, there's what they call Section 23M. This is technical. It's not important. Do get yourself a tax practitioner if you are not well versed in taxes, all right? So there's what we call Section 23M in the Income Tax Act. What that means is your deductions as an individual who is getting a salary for remuneration are limited to your provident, medical, if ever you actually have a home office repairs and all of that, but they are very limited. Okay, so that means you are actually getting more of your salary exposed to taxes because of the limitation in those. But if you are earning more than one income, if you earn a salary and commission, then that Section 23M falls away. Then you can claim more taxes. Do you get my point? Now, This is very key because of most of us don't understand that our lifestyle is based on the gross income amount that the companies give us. Yet our take home is normally less than 60% of the gross income we get from work. Do we understand that? Now, what that means is that we normally patch the 40% with debt. Debt can be good if you know how to use it in order for you to reduce your taxes whilst you're buying assets that appreciate in value. But if you take debt in order for you to sustain your lifestyle, you are in trouble. So when you buy a property, then you are enabling yourself to claw into more deductions, because those who buy properties, right, they buy them either to stay in them for investment purposes. Now, that means there, if you are going to stay in it, you have one, personal use benefit. Number two, you have your capital appreciation benefit. Hopefully, we have bought in the right place. Over time, you are hoping that it's going to appreciate in value. And this is the one space that enables every employee to start a side hustle without having to put money in it. What does that mean? Or when you're an employee, you actually have something that's powerful called the pay slip. The pay slip enables you to go to the bank and ask the bank to give you money in order for you to buy an asset that appreciates in value. All right. And that is a property. Now, this is the one asset that banks are willing to give each and every one of us who has a pay slip and that has a good credit record. They can actually fund you fully. We are on what, 7 properties now. And we all of those, we bought them using the bank's money, and we were fully funded. So for those who actually think after the first one you can, if ever you after you buy the property, you get tenants, you get them in, you make them sign a lease agreement. Your income, the one that comes from work, gets supplemented with the rental income that is shown in your lease agreement. Then the bank sees you as someone who earns more than just salary. Therefore, your credit rating goes higher. Are we together? Now, very briefly. Now, so when we then come back, you buy this property using your pay slip, then the bank gives you. By the way, banks favor pay slip over annual financial statements. Banks favor pay slip over annual financial statements. I'll tell you why. Your pay slip is speaking to retirement. Your annual financial statement speaks to historic performance. So the bank does not know that what you did last year can happen again this year. So the risk that is attached to those who come with financial statements to the bank is higher than those who are employees. So don't sleep on the superpower that you have. So you get then the bank gives you the money. Now, I've told you, you're using someone else's money. You might have the money cash. Please don't buy property using cash. Cash flow is very key. Uhomo did touch on the fact that cash is king. It's very true. Most businesses do not fail because they don't make profits. They fail because of lack of cash flow. You can't pay people with profits. Profits are a theoretical concept, accounting, but then cash flow is money that you have in order for you to do things. Day to day takes cash flow, not profits. Please, let's take that into consideration. Now, I've gone over, I've gone ahead of my presentation. But anyway, so we then you get the money, you buy this property. Now, if you buying the property in order to rent it out, you have a number of benefits that are there, right? You are almost hedging. Hedging is when you actually protect yourself against inflation on property when you buy it using credit. That's the first thing, right? Because what happens is, if I buy a property today for 2 million rands, that property 10 years from now might be 3.5 million. Do you get my point? But if I buy it today, even if I don't have the 2 million, but I use the bank's money, that liability will never go up. It only goes down if I repay, right? That means it's only subject to interest rates, not to inflation. Now, the lovely thing about this is that at a certain point, I lock the value of that asset. Sorry, I don't lock the value. I lock the amount of money that I put into that asset, but then the value of that asset is not kept in that same place because it's a natural progression that it will get to 3.5% to 3.5 million 10 years down the line. And my liability then might just be, let's just say, so as to be conservative, it might be R1 million. Now, in accounting, there's what we call accounting equation. Accounting equation is what the whole accounting system is actually built upon. Your balance sheet is based on accounting equation. It actually says, it's a formula, simple formula. It says your assets are equal to your equity plus your liabilities. All right? At least I can see the accounting students here. So it's your assets are equal to your equity plus your liabilities, right? Now, what happens is at the beginning, at the point when I'm buying this asset for 2 million, in my assets, I'm getting a 2 million, right? Because I'm getting this property. Then in my liabilities, I also have 2 million. In equity, I have 0 because I don't own anything in this. The bank owns this thing fully. 10 years down the line, the asset is 3.5 million, right? Now that's what's on my assets. My liabilities, it's 1 million. Now, in order to balance the equation, there is a 2 million that's missing. That 2 million is what we call equity. My time. I'm about to conclude. All right, just to land it. Now, that means there is 2 million rands worth of equity that I have gathered with an asset I bought using somebody else's money. I can sell this house, pay the bank their million, or did I say a million? I don't remember now. Yes, pay them the million, then I'm left with 2.5 million. Or I can go to the bank because this thing is not going to stop appreciating because I sold it. I can go to the bank and refinance. That's another terminology we're going to explain someday. Refinance. So I'm getting to the bank. I'm saying, listen, the asset that I bought from you, when I bought it, it was 2 million. Now it's actually 3.5. And I owe you guys 1 million. There's about 2.5 million there. Actually, I'd like you to give me that money against that same asset because the property is considered a secured, when you give in a bond, it's a secured loan. That's why the risk is low because it's against an asset. Whenever you default, the bank will take that asset and sell it. So they know it's not like giving you an unsecured loan. So they are secured. Do you get my point? So you go and refinance, you get that 2.5 million. It's your money. You didn't have it. You didn't do anything. It just came with the appreciation of the value of the asset and the reduction of the liability. And then you got what we call an equity. You take that 2.5 million. You go and you either buy another property. Just don't go and blow it. We'll talk about that some other day. Just don't leave in order to impress other people. Just make sure that you have a clear vision. It's mostly when you're going to actually invest in property. So you take the 2.5 million, you go and you can deposit 2 million rands worth of houses at 10%. And that 2 million rands is still yours. Now you have 10 properties that are appreciating same way as the first one for you. And then the last thing, with the rental income that you're getting, because with more money that you're getting, more taxes, if you're using the bank's money, you can take the interest expense and deduct it against the rental income that you are getting. And by the way, between 85 to 90% is interest portion on your repayment on your bond. That means then you are always going to be on a refund basis for tax purposes. That's another money you put towards an income and an appreciating asset that can actually continue to grow over time. I just don't have enough time to break other things down, but I just want to ask, is there anybody with questions? Otherwise, this is going to be a talk.